You're listening to the Moneyweb Now podcast series with Simon Brown. Live streamed every weekday at 6:30 a.m.
It's Friday, 7 August. We've got US unemployment rate due this afternoon. Expected, no change, 4.2%. I'm Simon Brown, coming at you live and loud from the Moneyweb Global Headquarters in Johannesburg, South Africa. On the show today, Matete Thulare from Investec. I want to touch on the Sappi results. I mean, they look not bad, but I mean, Sappi, it's a tough stock. And then Pick and Pay had an update, maybe looking a little bit better there, but still a tough space. We're going to be chatting with Dhersan Chetty from Foord Asset Management, the thrifty shopper, and how that's reshaping the South African retail landscape. And then thoughts from me as the hyperscalers shift from being asset-light balance sheet businesses to, frankly, asset-heavy and in some cases, negative cash flow. This podcast is brought to you by Foord Asset Management. Invest in more global opportunities through their partnership with JP Morgan Asset Management. Morning headlines: Moneyweb, Purple Group's Easy Equities and Absa strike digital investing deal. Go live date set for September. Business Day, Kanyaku says food inflation risk persists on El Nino and fertilizer costs. Morning markets, US was red. S&P and Nasdaq down 0.2%. Over in the east, it is mixed. We've got Sydney up 0.2%. Tokyo's down 1%. Hong Kong is up 0.1%. And Tencent down 1/3%. Commodities mostly red. Gold futures 4,319. Brent is the green, 82.62. Platinum 1,749. Palladium 1,373. The rand is 16.37. Bitcoin 64,500. And top 40 opening call, we are expecting a red open 550 points, or a little over 0.5% lower.
Moneyweb Now, on the money. Also available on podcast.
Chatting now with Matete Thulare from Investec. Matete, always appreciate the early morning time. Sappi numbers. So they talk around improved profitability in the North American region. This sort of leads back to the update they gave us back in early July, the Somerset Mall. Stronger rand is hurting them a bit as well. But I don't know. I mean, Sappi is just, it's a volatile earning stock, I suppose, is how we put it politely. It's good one day, it's rough another day. Your thoughts?
Good morning, Simon. Happy Friday morning. Look, for Sappi, I think also what worked for them was their cost control. Management really highlighting their disciplined cost containment yesterday. And then also the encouraging sales performance, even though we've got a challenging backdrop in terms of the macroeconomic conditions. It means that volumes didn't really fall off a cliff. I mean, last year in December, we did see that big EBITDA drop. If quarter three this year is still talking stabilization, I suppose the market will read that as a bottoming. And I mean, like you said, the key feature of, the results was the improved performance in the North American operations. I mean, they have said that North America will be a key driver for them in the coming years. It did deliver a significant improvement in profitability on a quarter-on-quarter basis. But also, when we look at it, it wasn't a blowout performance, but it was resilient. In a weak global pulp market, they've really managed to contain costs and hold up sales. The real story, though, is the pivot away from paper, into packaging and dissolving pulp. If those prices keep climbing, definitely the second half for them looks much better.
You make a great point there. I still, same with Monday, I refer to them as paper companies. They're not paper companies anymore at any stretch. And if anything, they really are much more about packaging, and whether that packaging be my order from Takealot to Amazon, or perhaps the citrus fruit we're exporting to Europe.
Exactly. But I think also, with the big online shopping, phenomena that's taking place, I suppose also for them, that's going to be maybe the next big drop that they'll look at. People also ordering online and obviously pushing the volumes there. The likes of Takealot. I'm a late bloomer in terms of technology, but I've already seen that, already that's a new market for them. So I suppose it's actually the pivot away from paper into all of the other sectors of the market for them.
Let's move to same but different, Pick n Pay. The like-for-like is still their key indicator. It's still tough for them, but maybe looking a little bit better for Pick n Pay. And what is a tough market? To be clear, I mean, we've got inflation, we've got consumers under pressure, not an easy space to be operating.
Look, Pick n Pay is a tale of two brands. I mean, Boxer is flying and it's masking the pain in the core supermarkets. I mean, yesterday when we saw that the numbers, group up 2.7%, but Boxer, up plus minus 7%. That's doing all the heavy lifting. The pain is still there. The turnaround is pushed out to 2029. There's a Section 189 process that's in the works. Pick n Pay at this moment is Boxer and everything else. Boxer's growth means that the discount retail is winning, and also the consumer is under pressure. So therefore, that is helping them. The core supermarkets, they're healing slowly, but I mean, we've seen it is a 3-year fix. And I mean, already with where you're seeing the group growth at 2.7%, it is credible in a weak consumer environment. But I suppose up until they fix their labor costs and also some of the processes in the closure of some of the stores, the turnaround is still years away. And I think the market will continue to watch if like-for-like momentum can continue. On the other side, Pick n Pay needs the South African consumer to come back into their stores and also the core business to stop losing money, especially given the fact that we've seen that ShopRite is not letting things go. And obviously, they're trying to really stamp their footing in the retail market.
You make a great point there. I mean, this is, we can talk Pick n Pay all we want. The point is they're competing against ShopRite, which is, I mean, ShopRite's world best. It's not just a tough consumer, it's a tough operating environment when your competitor is the likes of a ShopRite.
Exactly. And I mean, also, I think that the big takeaway is also what happens from an online shopping perspective. I mean, you've seen Pick n Pay releasing some of their new AI shopping online, and also the likes of ShopRite, also with Checker 6060, they improving their online capabilities. That is a new growth phenomena, but also still people walking into the stores. We've seen the numbers from ShopRite. They're not letting things go. But I suppose that I think for Mr. Summers at Pick n Pay, as he said, I mean, he's really letting the market know that it's not a 1-2 year growth story. It's a 2029 story before we can actually say Pick n Pay is in the black and not in the red. Yeah,
it is. It's a multi-year story. And to be clear, that story has pushed out at some years. We'll leave it there. Matete Thulare, Investec, appreciate the early morning time. The Standard Flexible Income Fund delivers capital preservation and consistent top quartile inflation-beating returns. Let your money keep working with Foord Asset Management even after you retire. Is property making a comeback or are investors walking into another trap? Join Moneyweb Deputy Editor Suren Naidu in conversation with hyperscaler Capital and Merchant West Investments as they unpack whether property still deserves a place in your portfolio. Discover where the opportunities lie, the risks to watch, and how interest rates, valuations, and market demand are reshaping property investing. Tuesday, 1 September at the Sandton Convention Centre. Register for free using the promo code Moneyweb. Visit moneyweb.co.za and secure your seat today.
Moneyweb now, on the money.
Chatting with Dhersan Chetty, equity analyst at Foord Asset Management. Dhersan, appreciate the time today. Consumer confidence, a recent note you put out, negative for 7 years. I hadn't realized it had been that long. I know it's tough being a South African consumer, but we're talking like back sort of pre-pandemic that we've seen the squeeze on consumers. We haven't stopped spending, but we've certainly had to get smarter about how we spend our money.
Yeah, you definitely do. I think it's been a very resilient segment because, I mean, food is essential. But what's amazing about food is that it only had 4 years that volumes were negative, and food retail sales have never been negative. But you are going into, as they do pass on food inflation, the retailers, but we are going into a much weaker consumer going forward. And you can see the signs of that pressure even in the high end. And you can see it with the low end also.
That's a good point because, I mean, it's around, we've been shopping smarter. We're using promotions. I imagine a lot of brands switching at the same time as well to sort of try and keep things on the table, but, less money to go around.
Yeah, I think the brands, it's interesting to see how the consumer behaves because the brand perception is what drives sales and the instant promotions, and the consumer has to be a bit more savvy. So I think there's going to be more a rotation into different retail brands, and those that have that cheaper perception, those that are already cheaper or using their scale. So it's going to make it a little bit harder for some of the other retailers, especially with a weak consumer and protecting GP margins, to remain competitive.
Is it as simple then almost to say the winners here is broadly ShopRite, narrowly Checkers, and especially 60/60?
Yeah, I also think Boxer will do very well. So I think they are leading the front in terms of their model, in terms of differentiation and low SKUs to get deeper promotions. And they already have a lower price point than their peers. So I think they're also included in that mix of down trading from consumers.
Let's delve into that Boxer, because as you said, they do it different to perhaps the others. It's very much that discount model. There's less product range, but it's high volume, sort of low price. In a sense, classic discount retail.
Yeah, I think the key here is that in the categories that they do play in, they have very high market share. And because they're growing volumes at such a strong pace, the suppliers want that volume. And as they grow into more space, that volume grows even further. So they can actually get some really good promotional pricing if they can deliver on those volumes. And then on top of that, they got a very low cost model, very simple DC. And then that just creates more sustainability in terms of your margins.
And that then, that comes back to the ShopRite Checkers, where they've got the DCs by the dozen. They've got the suppliers, they do the volume. They've also got data on the customers as well. They're never out of stock. The formats work. They're the other side of the equation, but doing it as well in many ways.
Yeah, I think they will. I think they'll continue to do well. I think the most important thing is being able to execute and to use those promotions and use the data from the loyalty card, and then the strong private label. Retail, you have to do a lot of things well to be competitive.
That's a great point. It's not just any one box, it's many of them. But where does this leave Pick n Pay and Spar? Spar, the convenience, Pick n Pay used to be about price. The older listeners will remember the sort of Raymond Ackerman days of Pick n Pay. They seem to have kind of got a little bit left on the wayside, particularly Spar in terms of convenience, when I can now sort of get it delivered via a 60/60 scooter.
Yeah, I think Spar, there is a lot of internal issues that they had also. So that also compounds it. And then with the franchise model, sometimes it can be harder to execute because ShopRite management team can make a decision and it's executed at all the stores very quickly. So there is a bit of a leakage there. But some of the franchisees and Spars are very good, and obviously some are not. And then the convenience side on 60/60 did definitely hurt that model.
What about Woolies? They obviously a bit of a top end. They've also got the fashion, the beauty side, been struggling a bit. Where does Woolies sit in all of this?
Woolworths has grown like-for-like sales quite strongly. It has slowed down like everyone else. But I think they do have a differentiated model in terms of their fresh offering, ready-to-eat, high-quality products. But I think they can definitely improve their online offering.
Yeah, I was going to say, their online, I think, is perhaps in their delivery is their weak experience. A question around food is private label. I'm surprised perhaps, and maybe I'm just not a good shopper, I always expect to see more private label in our stores. It seems an obvious way to try and help the consumer on price. Where do we sit as a private label as for consumers?
It's actually amazing. I think private label penetration in this country is starting from a high base. So we are sitting at, I think, around 23-25% of sales is already private label. And I saw some stats that the global average is 15. But what's interesting is that you look at ShopRite, which is one of the best players in private label. They only grew sales in private label 6.6% in 2025, which is slower than their group sales. So I think one factor is that you do have a lot of good food producers that are also lowering their brand premiums. They're also lowering their cost of manufacturing, value engineering, launching cheaper variants. And then you also have, private label needs capacity, and there isn't that much food manufacturing capacity out there. That also restricts some of the private label growth.
I take that. And also, as I'm saying private label, I'm sort of thinking back to the anonymous milk carton. But for example, with Checkers, the Forage and Feast fits in there, as I would imagine as well, which is kind of, middle to upper.
Yeah, I would think that the secret that they've done is similar to what Clicks has done with private label, is that you buy a brand of private label that you might not even realize is private label, or if you know it's private label, you trust it more because the branding around it. So Simple Truth and Forage and Feast have created very good private label brands.
Yeah, I do suspect. I know about them as private label because I'm in industry, but I'm not sure everyone does. Moving away to a bit and thinking about clothing for a last question. This is obviously a tough area. It is more discretionary. It's got brutal Chinese competition. Is it as simple to say that the sort of lower cost and sort of cash-based, which is maybe Mr. Price, are the better positioned here?
No, I think in a weaker consumer environment that we're going into, I think discretionary items will be impacted. And we can look at, the like-for-like sales of the retailers have been quite tough, around 0 to flattish. We saw with Pick and Pay today, it was down 1. So I think people are, if you're under pressure, then you kind of reduce your non-discretionary spend. And the competition is tough.
Yeah, and I can probably wear that shirt for, another season perhaps before replacing. It's not food. I need to eat. We leave it there. Dhersan Chetty, equity analyst, Foord Asset Management. Appreciate the time. And that's our poll today on LinkedIn. 7 years of negative consumer confidence. Wowza. I hadn't realized it was that tough. But how's your shopping changed over the last few years? Have you responded? Have you adapted? Have you changed? Have your vote? Have your say? LinkedIn. Give your money the return at once without taking a flight with the Stanlib Global Select Fund, an offshore equity fund submanaged by JP Morgan Asset Management.
Moneyweb now on the money.
Thoughts from me on the shift, the change that we're seeing in the hyperscalers, what's it? Amazon, it's Microsoft, it's Alphabet, it's Meta. We know what they're doing. They are building data centers. They are spending literally hundreds of billions, each of them per year, and those numbers are only going higher. And it is changing how they look, and we need to sort of potentially adapt as an investor. So they used to be, back in the day, what we would call asset light. Think of Alphabet and Meta. They weren't even a very fancy website. They were just a website. Not massive cost to it, but huge revenue coming in, giant margins, and very little on the balance sheet. Just some websites. So Microsoft would make a piece of software and it sells it millions of times. Again, not much on the balance sheet in terms of assets and the like. So that was what they used to be, and they used to, as a result, be very, very cash generative and spending on that cash. But this AI infrastructure spend is changing things. Free cash flow is fading, or in the case of Alphabet, vanished. Alphabet had its first quarter of negative free cash flow since listing over 20 years ago. They've never done this before. And that was all on the back of that spend on infrastructure spend out. We're seeing, in some cases, debt rising. We've seen Meta taking on more debt. Alphabet's issued debt. We've also seen share issues out of, again, Alphabet raising money from issuing new shares. Now, to be clear, not the worst idea, particularly if your valuations are high. We're also going to see reduced share buybacks, right? That free cash that they used to generate would then be used for many things, including the share buybacks. But that no longer is applying. We're going to see a lot more companies cutting back on share buybacks as we go forward. And then, of course, depreciation. They've got all these assets on the balance sheet, and at some point they need to exit the balance sheet. Typically, these assets, the hyperscaler, saying that their data centers got about a 5 to 6 useful life span. So about 15 to 20% of this cost is going to come out of earnings in the years ahead over that 5 to 6 period. Some people, Michael Berry, will tell you, actually, economic life is closer to 2 to 3 years. That is something to keep an eye on. It's not cash on the way out, but it was cash on the way in. It is going to change issues. And what is that useful economic lifespan, and how do the companies manage it? So let's be clear. The spend is not necessarily bad. The changes are not catastrophic. But as investors in the space, we need to understand that these companies are shifting from what they used to be into new types of businesses. And we need to be very cognitive of what we are now investing in compared to what it was even as recently as a year ago. That's it for today. I was chatting with Kian Nyani yesterday from Prime XPT. We were talking precious metals as they're starting to move higher. Gold and PGMs. Asked you if gold was finally regaining some momentum. Half of you said you hope so. A third said, yep, definitely looking good. The rest said, no, this is a false break. Have your vote. Have your say. LinkedIn. This podcast is brought to you by Foord Asset Management. Invest in more certainty to navigate volatile market conditions. We're live every weekday morning, the Moneyweb website and the app, 6:30 a.m. podcast just after 7. Thanks to my team, Eddie Nabuchle, Nicole Sabut, to you for listening, my guests for their time. My name is Simon Brown. This is Moneyweb Now. We'll chat again Tuesday while chasing famous investment names. Hertz returns.
You've been listening to another Moneyweb Now podcast, posted every weekday at 7 a.m. on moneyweb.co.za. Moneyweb Now, on the money.